Welcome to the Legal Leverage podcast. We work with founders and growing businesses every day, and what we see behind the scenes is often very different to what gets talked about publicly. So this podcast is about closing that gap, giving you a clearer view of how things actually work when you're scaling a business, raising investment, and making decisions that really matter. If you're raising investment into your business, there's a moment that almost every founder hits. It usually starts with excitement, someone's interested, there's momentum, conversations are happening. And then almost without warning, it becomes quite serious. You're no longer talking about growth in abstract terms, you're talking about giving away equity, sharing control, and formalizing a relationship with someone who now has a stake in your business. And that's the point where most founders realize this is not just a commercial process, it's a legal one, it's a structural one, and in a lot of cases, it's a permanent one. What I want to do in this episode today is walk you through what actually happens when you raise investment. Not the polished version that you see on LinkedIn, but the real process. How conversations start, what investors are actually looking for, what due diligence really involves, what all these documents mean, term sheets, heads of terms, shareholders agreements, and where founders tend to get this wrong. And I'm also going to be quite clear about something throughout this. The legal side of this is not just a formality, it's not just paperwork, it's where the deal actually exists, and it's where you as a founder needs protection. So let's start at the very beginning. Because most founders think that raising investment starts with a pitch deck, but it doesn't. It starts much earlier than that. It starts with how your business is structured and presented before you even speak to an investor. For example, if I asked you right now, who owns your IP? Are all your contracts properly documented? Is your cap table clean? A lot of founders wouldn't have a clear answer, and that's not particularly unusual, but it becomes a problem later down the line. Because when an investor looks at your business, they're not just looking at the idea, they're looking at the foundations of the business. Let me give you a real world type example. So we see this quite often. A founder's built a business over a couple of years. They've used freelancers. They've maybe had a co-founder who left. They maybe haven't formalized everything properly. Everything's been fine operationally, but then they go on to raise investment and suddenly the investor asks, can you confirm you own all of the IP? The answer actually isn't completely clear. Now, that might not kill the deal, but it does slow it down. It creates friction, it creates doubt, and in some cases, it reduces the valuation that the investor is willing to invest based on. So before we even get to pitch decks, you need to understand that raising investment exposes whatever is already there, good or bad. Now let's talk about pitch decks, because this is where most investors start focusing their attention, and rightly so to an extent. That's how you're selling your investment. But I want you to think about this slightly differently. A pitch deck isn't just a sales document, it's a representation of your business. And that is what matters, even from a legal perspective. If your pitch deck says, we have exclusive rights to X, or we've secured these partnerships, or we've built this technology, those statements aren't just marketing, they're statements of fact. And when you move into due diligence, those statements are what the investor is going to test. So if there's any disconnect between what you say early on in the process and what you can evidence later, you don't just have a commercial issue, you have a credibility issue, you have a trust issue. And credibility is everything in an investment process. Now, once you've had those initial conversations and there is interest, you move into what I would call the informal negotiation stage. So this is meetings, follow-ups, discussions around valuation, discussions about how much is being invested. And this is where something quite subtle can happen. Founders often feel that they're still exploring, but investors are already forming their position. They're taking their position on value, control, risk, and importantly, they are anchoring expectations. So if you say early on, we're looking at a 5 mil valuation, that number doesn't just disappear later, it becomes the reference point. And this is where a lot of founders weaken their position without actually realizing it, because they haven't thought through what they actually want, what they're willing to give away, and what the deal should look like. Now let's move into something that people hear all the time but don't always fully understand. Heads of terms, term sheets, letter of intent. In simple terms, these are documents that set out the commercial deal before the legal documents are drafted. They typically cover how much is being invested, what percentage equity is being taken, what rights the investor has, how decisions are made, and what happens on an exit. Now, you'll often hear people say these documents are non-binding, and technically, for the most part, that is actually correct. But it's also one of the most misunderstood parts of the process. Although these documents might not be legally binding in full, they are commercially binding. So, what I mean by that is once you agree a term sheet, you're very unlikely to be able to materially change the terms later on. So, if you agree a valuation that's too low, investor rights that are too broad, control mechanisms that restrict you, you don't fix that later in the shareholders agreement. You have to live with it. And this is one of the biggest mistakes that I have seen founders make. They treat the term sheet as we'll deal with the detail later, just get it signed and get it started. But you won't. That is the deal you're agreeing to proceed on the basis of. Now, let's talk about the different types of investment because this is where context really comes into it as well. There are different types of investment. If you're raising from friends and family, that dynamic is completely different. There's trust, there's informality, there's often a reluctance to let things get too legal. And because of that, people can skip a proper structure. So they don't document properly, they don't think about future rounds, they don't consider what happens if things actually go wrong. And that can work until it doesn't. And that is a big issue. Because when you bring in a more sophisticated investor later, they'll look at that structure, and if it's messy, they're either going to require you to fix it or they're going to price that risk into the deal. Then we have angel investors. So you kind of get something in between there. You have more structure than friends and family, but still relative flexibility. And then we have venture capital firms, and it's a completely different level. VCs are experienced, they're structured, they're very focused on protecting the downside for them. This is where you start seeing things like liquidation preferences, anti-dilution provisions, investor consent rights, board representation. So let me explain these in a bit of plain English. So a liquidation preference, that's essentially about who gets paid first on an exit. So if your company is sold, the investor may have the right to get their money back before you even see anything. Now that might sound reasonable, but depending on how it's structured, it can have a huge impact on what you're actually receiving. So for example, if an investor has a 1x liquidation preference, they get their money back first. If it's more complex, you have these things called participating preferences. It can go even further than that. And these are the kind of things that will always jump out when you read a document quickly, but they do matter enormously. Then we come on to other things like anti-dilution provisions. If you take in additional investment in future, the investor doesn't want to be diluted, but you will, your co-founders will, any other investors will. Investor consent rights. Any decisions you take will require the consent of the investor if they're in their investor consent list. And that list can be quite extensive. And board representation. In a lot of cases, the investor is looking for a seat on the board. Now, they might just have a seat as a board observer. They might just want to look at what you're doing, but they could have a say as a director on your board. And that can make quite a significant difference to the day-to-day. Now, once heads of terms are agreed, you move into the due diligence stage, and that's where the process becomes a lot more detailed. Due diligence is essentially the investor verifying everything about your business. So that includes corporate structure, contracts, IP, employees, financials, compliance, and that's where your data room comes in. A good data room isn't just a Dropbox folder with documents flung in. It's structured, it's organized, it's complete. And if you think about it from the investor's perspective, they are making a decision based on what they see. So if documents are missing, if information isn't clear, if things don't line up, that creates risk for them and or fear. And that risk and that fear affects valuation, it affects negotiation, and it affects sometimes whether the deal proceeds at all. We see this a lot. Businesses that are commercially strong, but they're legally just disorganized. And the result for their investment is delays, increased costs, and renegotiation on pricing. Now let's talk about the documentation involved in the round, because this is where founders will often think, can we just do this ourselves? Or can we use some sort of platform like Seed Legals to do this? And look, there is a place for platforms like that. If you're very early stage, if you're raising a relatively small amount, if you're dealing with very straightforward terms, that can be a useful starting point. But here's where it becomes a bit of an issue. Most founders don't recognize when they've outgrown that model, because once the investment size increases and the structure becomes more complex, the investor becomes more sophisticated, templates will definitely fall short. Not because they're wrong, but because they're generic, they're not tailored, and they're not negotiated. And with examples I have seen in day-to-day life with clients coming to us saying, these are our documents, they're the starting point, they've already been signed. And very often they're not in favour of the founder, they're very much in favour of the investor. Legal documents and investment are not just about recording the deal, they're about negotiating a position for now and for the future. And that's where proper legal advice comes in. Because a good lawyer is not just there to draft the documents. They're identifying risks, they're pushing back on terms, they're structuring the deal properly, and they're thinking about what happens in the future rounds, an exit, disputes. Because once these documents are signed, they don't just sit in a drawer, they govern your business. They govern how you operate, how you make decisions, what you can and can't do. Now let's talk about value, because this is where often founders will hesitate. Legal fees. And I understand it. You're trying to manage costs, you're trying to move quickly, you're trying to get the deal done. But you have to weigh that against what is at stake. If you're raising 500,000, 1 million, 5 million, you're setting the structure of your business going forward. And a few grand on legal fees should be a drop in the ocean compared with how much you could restrict yourself going forward. And the difference between a well-structured deal and a poorly structured one can be enormous in terms of control, in terms of value, and in terms of flexibility. So it isn't just about spending money for the sake of it. It's about making sure that what you're actually agreeing to actually works for you in the business. Because once it's done, it's very, very difficult to unwind. So if you take one thing from this episode and what I'm saying today is this: raising investment is not just about bringing money into your business. It's about structuring a relationship that you will live with for years. And the earlier you get that right, the better your position will be overall. If you find this to be a useful episode, please make sure to like and subscribe to the podcast and share it with other founders who are going through or thinking about raising investment themselves. And if you do want any help with this, whether that's reviewing terms, preparing for due diligence, or structuring an investment properly, you can get in touch with us today, info@jamiesonlaw.legal. Thanks so much.